we have a lot of companies exposed to Northeastern Natural Gas, EQT, Range Resources, Cabot. Which one is in the worst spot right now with natty gas about $1?
Well, I would say when you think about all four players, given the regions that they are exposed to, all of them have their pluses and minuses. Well, I'll give you an example. Range Resources in 2Q realized pricing was $2.95 per M. That was the highest of the four, but because of their hedged book, that added $1. So really the unhedged realized price was around $1.95. Now for the rest of 2015, they are 85% hedged, which makes them the highest of the four. Of the three, Cabot's policy is to be roughly 25% to 75% hedged. Southwestern is roughly 40% hedged. Now, it's not so much their hedged book, but also their cash costs. And when you think about the average for all four, their cash costs are right around $1 per M. So even with realizations being low and the basis differentials being wide, they're still in a better position relative to other players outside the play when we take a look at that cash unit cost.
But what happens when the hedges, first of all, when do the hedges roll off? Is it 2016 when that comes due?
So 2015, these hedges will roll off. In 2016, some are hedged. For example, Range is hedged for 2016, roughly about half of their output for 2016, the others less so. So 2016, there will be some impact if the basis differentials remain wide.
So $1 cash cost, I mean, that kind of blows my mind a little bit. How are costs so low for the Utica Marcellus?
It's a much more prolific area, and it's a wider area. And these companies have cracked the code for this prolific region, the Marcellus, and now the Utica. The Utica is a little behind the cost curve relative to the Marcellus. It's a newer, more recent play. For example, EQT did a successful test well at roughly $30 million. Now, granted, $30 million is significant. That should come on down over the course of the next couple of test wells. Their hope is to get it down to $12.5 million.